Good morning, everybody. Jamie Sumner here with me, Kyle Custer, and I'm sure you've already heard quite a bit about it. We had all the information out last week about the FOMC decision, which rates are staying the same at least until the next meeting. And there was some information that we really need to go over there, so let's get into it. The biggest thing I saw was the GDP change here. Their original projections in March were around a 2.2 for 2016, 2.1 for 2017. That's now been dropped to 2 flat. So we're lowering projection in GDP, which probably was tied into longer rates dropping as soon as the Fed released these projections. And that's, of course, indicating that slower growth is to be anticipated.
Mm-hmm. What's more worrisome, I think, is the fact that the longer run GDP has continued to be at that 2% level, just showing there's no real growth that they're seeing out there in the long term.
So let's get into the dot plot. The dot plot here, if we were to look at the last sheet, it shows that it has decreased. And we have a couple outliers here, which we're going to get into in a second. But as you can see, for 2016, the average projection is around 0.9%. In 2017 at 1.6, in 2018 at 2.4, long run 3% for the Fed funds rate. Now, what we want to show you here is, in case you haven't seen who this was a St. Louis Fed president. And he came out saying that he was not comfortable really projecting any further out than 2018, and totally kind of flipped his opinion and just started leaving rates at around the 0.75, and that's definitely a big switch from the typical Fed sentiment, which has always been above what they've been over projecting rates consistently in the past, and we're going to see that when Jamie goes over what the actual market is showing where they think rates are going to be.
That's right. So we've always seen this, the Fed's typically higher than where the market is. And we'll see this continue as we look into the future, into 2017. So if you look at the probabilities of a rate hike in July, which is the next meeting, you can see the probability is around a 12% probability of a rate hike. So not much of a probability. We have, down here 75 basis points. So there's only one 25 basis point rate hike there. If we look at where we are in November with the probability, skipping over that September, going into November, we see a much higher rate of about 40% probability. Still under a 50% mark, but a higher probability. Most likely, kind of unlikely that we will see a rate change here just because it's so close to election day. And then we can see here we're starting to move out to the highest rate here is 125 with a probability of less than only 0.1%. Looking at December, slightly higher. Now we're above that 50 mark at 54% here. And then we look at into February, we're at a 56% probability. Most likely going to be in that 75 basis point mark. So looking into the rest of this year, the next 6 months, and then into the beginning part of 2017, we could almost say that there could be one more rate hike. There's 25 basis points. So we're going to take that in consideration when we're looking at our ALCO models and doing our budgeting for next year. So that's what we have today.
Everybody have a great week, and we'll see you next week. Thanks.
Bye-bye.